What do EIA reports say about gasoline inventories and demand? Imagine trying to fill your car with gasoline and finding the station is running low. That's what traders and investors watch for in the latest EIA reports. These reports, from the U.S. Energy Information Administration, are like a snapshot of the country's gasoline supply and how much people are using. They give us a clear picture of what's happening behind the scenes in energy markets. Gasoline inventories are the total amount of gasoline stored at refineries, terminals, and pipelines across the United States. These numbers tell us how much fuel is available for consumers and businesses. When inventories are high, it usually means there's plenty of supply. When inventories are low, it can signal tighter supply conditions that might push prices higher. Demand, on the other hand, is measured by the amount of gasoline actually used by end users over a certain period. This is called product supplied in the reports. It shows how much gasoline is being consumed in the country. Recent EIA data shows gasoline inventories have been dropping sharply. For example, in late October 2025, stocks fell by nearly 6 million barrels in just 1 week. That was the largest weekly decline in over a year and much more than analysts expected. Because inventories are now below the 5-year average for this time of year, it suggests supply is tightening. When stocks fall quickly and stay below average, it can lead to higher gasoline prices, especially if demand remains steady. Looking at demand, the reports show that gasoline consumption has decreased compared to last year. Over the past 4 weeks, Americans used about 8.7 million barrels per day. That's roughly 4% less than the same period last year. So even though inventories are falling, demand isn't driving the decline as much as other factors might be. Changes in refinery operations, imports, or exports could be influencing inventory levels more than actual consumer demand. For investors, these trends are important because they influence gasoline prices. When inventories drop faster than expected and demand stays steady or increases, prices tend to go up. But if inventories rise and demand weakens, prices often fall. Currently, the situation is mixed. Inventories are decreasing, which could support higher prices, but demand is also down from last year. This makes the market more unpredictable and can lead to price swings. The EIA reports also give us a broader view of the energy market. They forecast that global oil inventories will increase through 2026, which could put downward pressure on crude oil prices. Lower crude prices usually mean cheaper gasoline for consumers. The agency expects U.S. retail gasoline prices to average around $3.10 per gallon in 2025. That's about 20 cents less than in 2024, with prices expected to fall further in 2026. For those investing in energy commodities, keeping an eye on these reports is essential. Weekly data can reveal short-term trading opportunities, especially when surprises occur. Longer-term trends in inventories and demand help shape expectations for seasonal changes, refining margins, and company profits. If inventories keep falling while demand remains stable or rises, it could signal a bullish market for gasoline. But rising inventories with falling demand might suggest a bearish outlook. External factors like geopolitical events, refinery outages, or export policies can also shake things up and change the game. In the end, EIA reports give us a straightforward look at gasoline supply and demand in the United States. They help investors understand whether the market is tight or oversupplied. By paying close attention to these numbers, traders can better navigate the ups and downs of gasoline prices and energy markets overall.